Welcome everybody to our first DCA stream. My name is Colin. I'm here with
Steven.
Steven, yes. And we're going to try to do this for at least a year and we'll see what happens to our portfolio after. Like we said in our intro video, we are going to try to do a $100 deposit every week. We'll record what we put in and we'll talk about why we put in the $100 into what we did for that week. So I don't know if you want to start, Steven, or if you want me to start.
Take it away.
Okay. So first of all, I forgot to explain this. We're gonna start with $1,000 as our starting balance, and then we'll DCA into $100 every week, just because of how I guess you're using Quest Trade, right, Steven? And we'll try to make videos about Simple and Quest Trade, but there is a minimum balance for Quest Trade, or they charge you a fee. That is not the case for Simply trading. So that is one difference. So with my first $1,000, I've split it into two different parts. One part is in my TFSA, and I have all my stocks in there, and then there is also a crypto account that you can put cash into to buy cryptocurrency. Now, and Stephen may want to talk about this later. You could be exposed to cryptocurrency through ETFs now in Canada. They have approved that. So if you want to stay away from the crypto account, you can, and you can get exposure that way. But let's start with my TFSA and my pick for our very first DCA. So it's gone down a little bit since I bought it this morning, but I put in $800 into the TFSA account, and I've purchased just a few different things. I think sometimes when we start out, even as traders that have been investing for a while, we sometimes make our portfolio basically into an ETF and have too many shares. So for people who are just starting, I've just selected a few items to get you started. Of course, not financial advice. These are just stuff that we like. Starting off, I like to talk about ETFs. ETFs are, you can think of it, if you don't know what it is, it's just a bundle of stocks that you purchase per share. So instead of you picking McDonald's and then another company and then the company, so on, you can buy one share of these ETFs and then you're exposed to a lot of companies in that basket that you're buying.
It's kind of like a mutual fund, but it's traded on the market and you don't have to go through like a financial advisor to purchase it.
Exactly. That is a really good point. And speaking of that, because they're not as actively managed, at least most aren't, the fees are less than that of mutual funds. I know mutual funds are very popular with a lot of people because, one, I think advisors just push a lot of people towards mutual funds, and it's simple.
Yeah, it's pretty hands off, right? Like if you just want to kind of set it and forget it and have a chunk of money when you retire, mutual funds kind of give you that. But if you want a little more active of a role in managing your retirement fund, then it's the way to go.
For sure. And even if investing makes your brain hurt, you can emulate a lot of the mutual funds yourself and not pay that fee by just buying ETFs, which is what I've done today. My first ETF is VFV and Vanguard. So I'm just gonna go over the description. So it's Vanguard S&P 500 Index ETF. So there are a lot of words there if you've never invested before. So first of all, Vanguard is just a company that manages this ETF. The Standards and Poor's, so S&P 500, is tracking the 500 largest companies in the U.S. So there is no S&P 500 for Canada. S&P 500, when you hear that, it refers to the U.S. market. And you might be thinking, well, we're Canadian. Steve and I are both in Canada here. You might be thinking, oh, why buy U.S. stocks, right? Like, why not just buy everything Canadian, right? Support your girl country. But the reality is that a lot of the largest companies with amazing growth and diversity is in the top 500 and in the US stock market. We just don't have that much diversity and exposure here in Canada. And maybe Steven will talk about this, or maybe we'll leave it for another video. But we're the Canadian market is dominated by a few industries, as opposed to I would say that the S&P 500 is dominated by a few sectors, namely tech, but it's still more diversified in the Canadian top holdings. So that's why I chose it, and I think it's a good one. There's enough companies that you're not putting your eggs into one basket. You know, it is the top 500 companies, and the S&P 500 have historically performed very well. It takes the guesswork of having to research a billion different companies, like I said about ETFs, and that's why I picked VFV. Just note there is another ETF that you can buy that tracks the S&P 500, and that's Canadian hedged. I can't remember the ticker code, but it's very close to this. Typically, if you think that the US dollar will outperform the Canadian dollar, I would just go with VFV and leave it unhedged. So it doesn't say that, but it is unhedged. So if the US dollar gets stronger, then it will perform better just because of the exchange rate. Next up, we have the other ETF in my TFSA is VCN. So similar to VFV, instead of tracking the 500, this is a Canadian all-cap index ETF. So Vanguard, same company like I was talking about, but this ETF tracks small, medium, and large caps. So when we're talking about market cap, we're talking about how big a company is. It's so share times price. And this basically tracks from the smallest company to the biggest public traded companies. So it's a wider range what it tracks, and not just the 500. And I chose VCN partly because there are ones that track, you know, the TSX top 60 or whatever, right? But again, just because of how it's less diversified in the Canadian market, I chose a all cap. So it's a little more diversified for the Canadian economy. So that's why I chose that, and I did a split of almost 300. They're close enough, 300 each, out of the 800 that I put in. And then just a couple guys. So one of the advantages of Wealthsimple, and I'm not sure if you can do it in Questrade. I don't think so, but I bought some fractional shares today. One of them being Facebook and the other one being Restaurant Brands. So Facebook, as of today, which is February 3rd, 2022, they took a huge hit to their share price and their market cap. It wiped out a lot of their shares. I think at this price it was a good pickup, so I just put in a little bit of money. QSR, Restaurant Brands, you might not recognize the name right away, but they own Burger King and Tim Hortons. And in Canada, Tim Hortons, I don't know if you're an American viewer, I what do you think is the equivalent? Dunkin' Donuts? I don't know what's down there. I'm really sorry. Yeah, okay, yeah. I wouldn't say they have a monopoly on coffee, but it seems like they're on every street corner. Burger King, they do okay. And then finally, I bought a share of TD. Canada is dominated by a few big industries, and the financial sector is one of them. I bought TD, and I think I will continue to buy in the future bank stocks because of the rising interest rates. So there are a few industries that actually benefit from interest rate increases, and one of them is the financial sector. So banks, your insurance, and that's because, namely banks, they can get more margins from the interest rate increase. When the interest rate is very slim, there's not much you can do with what there is. So that's why I chose TD. So yeah, that's everything for week 1. I'm going to quickly hop into my crypto account. I have Bitcoin, DOT, Ethereum, and Avalanche. So Bitcoin, I think for most crypto enthusiasts, there are even people called Bitcoin maxis who only buy Bitcoin. I'm not one of those, but some people only believe in Bitcoin. But nonetheless, Bitcoin has first mover advantage. It has the largest market cap. In the world of crypto, this is as safe as it gets. So I have a heavy weighting towards Bitcoin at 50% of my portfolio right now. Next is ETH. ETH is the second largest by market cap. I put in 50% because there's so much activity built on top of Ethereum. So many apps that people are creating now on their smart contract network. So they're building programs that are running on this blockchain. The majority of them right now are on Ethereum and are being used. In fact, if you know nothing about cryptocurrency, there is a transaction speed for how fast things can go through the network. And because of its popularity, one of the biggest problems Ethereum has is that all these apps that are running through all these transactions that people are executing, they're actually clogging up the network because Ethereum can't move these transactions fast enough. And the fee that you have to pay to execute these transactions, they get higher and higher, and they're very high. These are issues that are being currently addressed. The development team is doing a lot of stuff behind the scenes, but because it's such a massive beast, it's always getting delayed. Hopefully one day they can resolve these issues. Avalanche and Dot, they're basically competitors, I guess. Although a lot of people argue that they complement each other. So competitors complements layer ones. If you don't know what that means, don't worry about it. But there are also blockchains. There are also blockchains that are trying to solve the problem that ETH is having with scaling. Avalanche is a really good choice because there's also a lot of apps. Not nearly as many as Ethereum, but they're a lot more decentralized and the transaction speeds are faster. Therefore, people can execute all these apps with lower fees. And similar with Polkadots, they have their own individual teams, very, very solid teams that are working on these two different projects. And that's why I have this split. So because we just DCA'd, there's not much movement. You can see that my crypto portfolio went up $1, and then not much to say about my TFSA account. It went down a little bit, so obviously not much movement within a day. So with that said, I'll hand the baton over to Steven over there, and he can talk about his portfolio.
I made a crazy tracking spreadsheet,
Nice.
so I'm gonna.
I love this spreadsheet, by the way. This is amazing.
Yeah, spent a few hours making this. Yeah, Questrade slaps your account numbers and everything all over the place. So I'm going to primarily just be showing my investments through here. Yeah, so basically this first tab's kind of a main overview, and then I have tabs for my cash balances in my account, and then I have a tab for each stock. And this tracks my purchases for each investment, and then that all feeds into this main overview here. So yeah, so Colin focused mainly on stocks and crypto. Mine is going to be mostly ETFs for this dollar cost average project here. And the vast majority, 60% of my portfolio is going to be just based solely on index-based ETFs. So those, like Colin mentioned, the one that he bought that tracks the S&P 500 in the States, it's always just tracking those top 500 stocks on the Standard & Poor's index. So I'm taking a similar approach, but those are going to make up 60% of my portfolio. Kind of split it up between three here. So ZCN is Canadian index, XUU is American index, and XAW is a world markets index. So I've kind of broken it out between those three to get some domestic exposure and some global exposure as well. I didn't buy the same ones that Colin bought. So the Canadian one I purchased was the BMO Standard & Poor's TSX Capped Composite Index ETF, and this tracks over 200 of the top Canadian stocks. So it gets some real broad exposure. Looking at the holdings, these are some of the biggest ones. This one's also capped, so that no stock can make up more than 10% of the fund's total holdings. So if you look at this, actually some of the top ones are RBC, Toronto Dominion, Shopify, some of the biggest companies in Canada by market cap right now. And yeah, like Colin mentioned, Canada's market is a little less diversified. You can see it's really kind of concentrated in banking, energy, kind of industrial sector like railway. So we have CNR and CPR here. And I think Brookfield is a real estate company. So that's just 10 of the 200 or so companies that are part of this fund, but it gives you some really broad exposure, which kind of, that's the other part of an ETF, is that it kind of mellows out the ups and downs a little bit, because that fund should be pretty diversified across industries, particularly for these index funds.
So Steven, I have a question. Again, it's not financial advice, but why shouldn't I just put all my money into weed stocks and only weed stocks? Why should I buy an ETF?
Yeah. So that diversification, right? That really softens the blow. Like I bought some cannabis stocks last year, and they're worth like half what I paid for them. There was a merger, and then anyways, the cannabis market's way down. So in a diversified ETF like this, you lose on the industries that go down, but then you also gain on those ones that are going up. So for example, oil and gas has done super well in the last year during the pandemic, kind of rebounding as travels increased and things get slightly more back to normal. And banking is another one that's done really well in the last year. So by having a diversified ETF, you kind of smooth out the ups and downs a little bit. So less chance for huge gains, but also less chance for big loss too. Over time, particularly if you're planning on holding this till retirement, in the long run, it'll provide you some pretty steady gains typically, even if it has a super down year. As long as you have a long investment horizon, it should recover over time. And I haven't done much research on this, but people say that these index funds generally do as well or better than a private fund manager can typically do, managing your portfolio for you.
I believe that's true. I think over a long time horizon, studies have shown that actively managed funds do not beat the market. There are some fund managers who have done it successfully for maybe like a decade or more, but over long stretches of time, they don't beat the market. Yeah, so good point there.
Yeah,
Which goes back to our point of if you want to replicate that and follow the ETFs that you're talking about, you don't have to put into a mutual fund where somebody actively manages it and takes more fee than they should from you. So,
exactly. Yeah. With these ETFs, there is some management component to it, just in terms of rebalancing the portfolio, making sure if they have caps on the holdings that the stocks or other assets within the ETF stay below the cap. There's also some more actively managed ETFs, which I'll get into in a bit here too, where it is a little bit more like a mutual fund, where it's not just done against an index of the top stocks. And these are typically like industry specific ETFs. But yeah, they're a little more actively managed, and they do have a bit more of a fee. So ETFs always have what's called an MER, management expense ratio. And that's basically the amount of the fund that the manager will take as a fee from, I guess, like the fund balance each year. So yeah, you see this one is 0.06%. With a mutual fund, you're looking on the low end at probably 0.5% up to 2 or more percent, depending on the fund. So there is quite a bit less of cost to purchasing ETFs compared to mutual funds there. So that's the Canadian one I got. So the American one, XUU, Shares Core S&P US Total Market Index. So this isn't the S&P 500, it's the S&P Total Market Index. So it covers not just the bigger companies in the States, but kind of a broader one here. ETFs don't necessarily own just stocks. ETFs can own other ETFs, and that's kind of what this one does. So it owns more than half of it's in the S&P 500, which is the index that Colin's fund was tracking. But it also tracks a few other Standard & Poor ones, total US stock, mid cap, small cap, and super minimal cash holdings as well. So this one, yeah, doesn't actually hold any individual stocks. It's just tracking other index funds. So this one gives really broad exposure to the US market, which I was interested in. And then the last one here is XUU, All Country World X Canada Index. So yeah, this one has global portfolio diversification, and it's pretty low cost as well in terms of the MER holdings. Again, you can see this one. This is also just tracking other ETFs. So S&P 500, which is American, of course, but then some other ones, emerging markets. Yeah, this actually has a lot of overlap with the other one, but yeah, some more exposure to the emerging markets ones. I don't actually know what this one is.
I don't either.
Going on to the actual company who sells the ETF. So like, for example, these ones are RBC products. You can usually get some really nice detail about what's in these funds. Stuff like this, right? And just like a sector breakdown. So this one's 21% IT, financials, consumer discretionary, et cetera, et cetera. And also some geographic locations. So yeah, again, pretty heavily in the US. Maybe I'll buy some shares in one that's a little more outside of the US and Canada. But yeah, so Japan, UK, China, those are kind of some of the steadier foreign markets. Yeah. So that, yeah, so I do a little bit less in the world markets one, just 10%. But yeah, so that is kind of my three index ones, which make up 60% of my portfolio. You can see here. So yeah, this table here kind of breaks it down by sector, and then measures it calculates the total weight of my current investment against what my target is. So you can see my target index is about 3.5% below where I want it to be. Some of the others are a little higher. And we'll just balance that out kind of through the course of dollar cost averaging.
DCA journey, nice, yes. You raised a really good point. Tonight we've only really focused, and it makes sense because we're just starting to focus on the Canadian U.S. markets because we're more familiar with it, and they are large markets in the whole scheme of things. But I think in the future, at least for me, you raised a good point about countries outside of the U.S. and Canada. And if you're looking for the ETFs, they'll usually be called something like emerging markets or total market ETFs.
Yeah, I don't know. I haven't done a whole lot of research into those. There might be some, but yeah, like for this one, for example, it was like 60% US, 8% other, but then like Japan, UK, London, China, France. Yeah, so kind of some broader exposure. These are actually some of the more like steady like world markets, I would say, I guess, but a little less volatility.
I don't see Zimbabwe there.
Yeah. Index ETFs make about 60% of my portfolio. The other ones, I went for some more industry specific ones. So I have a couple tech ones that I'm kind of aiming for about 12.5% of my portfolio to be specifically in tech. So this tech, it's tech.to, it's on the Toronto Stock Exchange. This is, TD Global Technology Leaders Index. So it'll have some of the biggest technology companies on here. So you see like Apple's like almost 15%, Microsoft, Amazon, Alphabet, Meta, Tesla. Yeah, lots of the bigger ones. Some financials with Visa and MasterCard. They're kind of in that tech space as well, though. Yeah, so that is why I wanted that one, for that kind of good tech exposure with pretty steady tech companies. UFO is kind of just an interest one for me. So this one is from Procure ETFs, and this is a space ETF. So they
I like the name. I was like, oh,
that's pretty sweet that they got that ticker. This is actually the only American product that I bought. This one's traded on the NASDAQ. And yeah, so this one is kind of centered primarily, it's less around aerospace and more around satellites. So Sirius, SES, basically a bunch of satellite companies and GPS companies. There are other ETFs. There's another one called Rocket, ROKT, that's on exchange altogether. I can't remember, but that one tracks closer to aerospace, which also has a lot of overlap with weapons producers. some of the big weapons producers because they're also very heavily involved in aerospace. But yeah, so for this one though, I decided to just go with this one for now. So yeah, so it's some like nice exposure to stocks that kind of, I guess, like as the space race kind of reignites over the coming decades, should hopefully see a lot of growth in some of those areas as satellites and become more important. Yeah, and it's just kind of interesting. Yeah, other than that, I have one that is U.S. healthcare companies. So this one, yeah, lots of pharmaceutical companies, obviously. Yeah, these are just some of the biggest healthcare companies in the States. So yeah, a lot of pharmaceuticals. Yeah, but also some kind of like bigger companies like Johnson & Johnson that spans more than just pharmaceuticals. Yeah, so this one, none of them have really a huge weighting within the ETF. It's all kind of, yeah, lower under that 2% range, but there's a lot of different ones in there. So some broad exposure to the health space, which people will never stop getting sick probably. So the other sector here I have is energy. So I have half of it in clean tech and half in kind of traditional oil and gas. So Zclean, ZCLN, this is another Bank of Montreal one. Yeah, focused around lots of green energy companies. Yeah, they're nothing like super well known or notable in here, but definitely a growth industry with yeah, a lot of room for new innovation and stuff in the coming decades here. So as a long-term hold, yeah, I like this exposure for sure. And then the last one in the energy section is, yeah, this oil and gas one. So actually, I didn't actually buy any shares of this one this time around. I'll probably keep an eye out for it, but I do a little bit of technical analysis, and the technical analysis was very bad for this being a buy right now. It's performed super well in the last year. Okay. So it's very high. Yeah, looking at the stochastics, kind of like track different moving averages. It's super overbought. If it's over this line here, over this 80 mark, that means it's very overbought. Yeah, the MACD here, you watch for the purple one. When the purple one is coming up from under the orange one, that means it's trending up in terms of volume. But you can see this one's really peaking out. And then even you can see the price is way above the average. So we have the 50 and 200 day moving averages. It's just way above those. So yeah, this one, not really looking super appealing for a buy, but I do want it in my portfolio in the long run. So we'll keep an eye on that as we go.
Do you have a price target in mind for this?
No, not really. Yeah, just kind of once the underlying technical indicators are a little more appealing, okay, I'll get in. Hopefully it just keeps going up, but based on, yeah, buying patterns and yeah, all that, we'll see. Yeah, so the last two I have here. So I also wanted crypto exposure, but for the sake of this project, I decided, for now at least, just to buy some ETFs that basically track the price of cryptocurrencies. So I bought some Bitcoin, a Bitcoin ETF and a Ethereum ETF here. And I split them 50-50 here. One nice advantage of going the ETF route for some crypto exposure is that it's, at least in Canada, is tax sheltered. So because, yeah, Colin and I are both using TFSAs for all these investments, any profits that we make from these investments, super nice. So yeah, so that's kind of a nice way to get exposure for those. Yeah, there's nothing super fancy about these. They track the price of crypto. The fund holds some crypto as well. But yeah, it'll be interesting to see. I think there's probably not like the room for explosive growth with the ETF like there is holding the actual coin.
Yeah.
But yeah, some nice exposure for potential growth there.
Okay, very good. And like my portfolio, yours hasn't changed too much from $1,000 DCA that we put in for this week. Okay, very good. So that is where we are at the end of week 1. That's where our portfolio is at the end of week 1. It'll be exciting to see what what happens next week. The economy is in a sort of a weird wait and see moment right now with the whole interest rates, seeing how inflation will continue to change throughout the year. But yeah, thank you very much for joining me, Steven, this week, and thank you for everyone watching this. Again, if you haven't started investing, start this journey with us. It doesn't matter how much money you put in every week. As Stephen was talking about earlier, we chose $100 just because rounded amount. Like Stephen was talking about a little earlier, and we were both chatting. $100 is not something everyone can do every week, right? Try to put in what you can. The habit of slowly building your wealth through dollar cost averaging. Is there anything else you want to add, Stephen?
Yeah, you don't have to do it weekly either. As long as you're choosing a steady interval, so it could be once a month, it could be every payday, whatever kind of works for you. The key is kind of to doing it steadily, though. Keeping committed to it.
Excellent. Okay, so that's the end of week 1. This is Colin and Steven signing off. We'll see you next week for our weekly dollar cost average. See you guys.